Alright, let's talk about the M15 cycle, a cycle that the market always obeys, and when it ticks all boxes, that trade will not fail. Basically, we are going to be talking about the M15 cycle and becoming a master of reversals, only trading the M15 time frame. It is a non-subjective cycle that leads to an entry with only 3 steps. You are going to only need the 3 steps that I'm going to give you in this particular video. Everything worth doing requires patience and discipline. Remember, growth begins when you stop chasing quick results and start mastering consistency every single day. This is being said so that you know how to operate with this particular trading strategy. This strategy actually works on any asset and will work on the M15 time frame with 4 indicators and can be traded on the phone for those who do not have computers, and has clear targets that I'm going to give you. The mantra is cycle first and then the pattern. So you can trade any asset of your choice on the M15 time frame. It might be crypto, it might be Forex, or even indices. So what is the M15 cycle strategy? Let me explain. When trading, subjectivity is the biggest enemy because you cannot replicate what you did the last time. So indicators remove subjectivity in your trading. They do not predict the markets for us, but they give out valuable information and expose what the market makers intend to hide from you. All patterns that I'll show you will be clearly or actually smoothened out using indicators. So we are saying indicators do not predict the markets, but they give us information and reveal the hidden patterns the market makers intend to hide from you. These are the indicators you need to set on your charts so that the next steps will work perfectly. The 5 EMA, the 13 EMA, the 50 EMA, and the 200 EMA. For those who follow this channel for quite a period of time, you would know that I always use these exponential moving averages for the good reasons. So step 1 for the M15 cycle, we are going to require us to see the market cycle. The market cycle is basically a cycle the market does before it actually reverse. So in this particular case, we have 3 impulses. We have impulse 1, impulse 2, and impulse 3. So as I've said earlier before, to remove the subjectivity, we are going to require the EMA so that we know when the impulse starts and when the impulse ends. So basically the first impulse has what we call a 13 in red and a 50 in blue crossing over to the upside like this one. So this crossover tells us that the market is issued the first impulse or impulse 1 to the upside, and then when it comes and bounds on the 50 EMA, it tells us that impulse 2 is now about to start. Impulse 2 will always start when we see a 5 EMA crossing a 13 EMA like this. That is for impulse 2, and then impulse 3 has the same characteristics whereby it actually starts from the 50 EMA and give us another 513 EMA cross to the upside like that. So these 250 EMA touches are required for us to see or to say a cycle has been issued. After step 1, where you've seen the cycle has been issued, you actually jump to step 2, where we now talk of pattern identification. And pattern identification is done at the end of impulse 3. So we have impulse 1, touch of 50, impulse 2, touch of 50, and then on the third impulse, that is where we want to see a pattern in form of an M or W pattern. In this particular case, we had a triple top where we had 1, 2, and 3 like this in this particular instance, and we actually could enter on the second leg, although the third leg was issued, which is not a problem. Step 3 is now for us to exit when we have actually attained level 1 or of impulse 1 with a 50 EMA cross, impulse 2 with also a 50 EMA cross, impulse 3 with another starting from another 50 EMA cross, and then we get a pattern, an M pattern or a head and shoulders pattern, depending on what the market makers have decided to do. You can enter, and then your exit should be done on the 200 EMA, which is this particular EMA that I've shown. Alright, so to consolidate everything that I've showed you, let's now jump over the charts so that I'll explain much further. But before I do so, check out my free Telegram channel. I'll leave the link in the description box below. See you on that side. Alright, so basically we are going to use BTC against USD as our example for what we have learned so far. We can see that in this particular instance, we had impulse 1, and that impulse had what we call the 1350 EMA cross. So in this particular case, we are going to mark these impulses with rectangles. So we had this particular crossover of the 1350 that was issued at this particular point, and that was 1. And then the second impulse, we've said it starts on the 50 EMA, which was done here, and it should always try to break structure or the low of the previous impulse. So in this particular case, we had this crossover and a crossover of the 513, which is yellow and red crossover, confirming that we are now in a flow to the downside. Therefore, we had this as our second impulse to the downside. We've said the cycle should always have 3 impulses in one particular direction, and then we move to step 3, which is basically pattern identification. On the step 3, we can see that after the cycle was issued to the downside, we had a W pattern, first leg and then second leg. We can actually enter or make our entry whenever a candle closes above the 13, which was issued at this particular point or at this particular point. Stop loss is always done below structure, and we've said our exit must be at the 200. In this particular case, my 200 is in white. That is where we would exit like that, and we can start again to look for an entry whereby we can see there was another crossover of the 50 13 EMA to the upside, and it came back to the 50 EMA. So this was the first impulse to the upside, and it came back to the 50, and then we had a crossover of 513 for impulse number 2. So impulse number 2 is coming from this particular point. We can actually say this was the rise that was issued. So this was the second level or the second impulse, and then we can see the market coming back and trapping below the 50, which is also normal. They can go below the 50 and then come back to close above the 50, which is also called a trap below the 50. And then we had 3 impulses to the upside, or basically 3 levels. We've said step 3 is now to look for a pattern, which is an M pattern that was issued here, first leg and then second leg at the level of the first leg level, and then we can see the market going to the 200 EMA. Here was our going to be our exit, and then we start again to look. So we can see going on, we can look at the market and see that it always tried to mimic that particular move. 1350 EMA cross to the upside, and then after that 1350 EMA cross, we can see the market went back to the 50 and moved to the upside, went back to the 50 and then moved to the upside to reach what we call the impulse 3, where we actually now start to talk about the step 3 of our methodology, which is pattern recognition or pattern identification. We can see first leg and then second leg. This week, of course, was likely going to take us out because it was actually meant to do so. So in this particular case, our re-entry was going to be at another crossover or at another closure below the 13 EMA, which was at this particular point, and then the market would go down right to our target point, which is the 200 EMA, basically like that. So if we keep on doing so, we can see that the market would try to do so over and over again. In some instances, it's tried to consolidate over the 50 EMA, but an impulse will be actually important. So like in this particular case, we want to recognize a pattern so that we can drop right to the 200 EMA on this particular asset. On that note, we've come to the end of our today's video. Thank you for watching, like and subscribe, and I'll see you in the next one.